Hey, welcome back, everybody. We have guest Dan Golden with Cross Country Mortgage.
Hello, good morning.
All right, so here we go. Today we're going to discuss 3 buyer strategies to get the best mortgage rate. Now listen, rates they're bobbling around every single day. They've been on a upward trajectory for a while. If you've been watching the channel, you've understood that that is expected. As we kind of roll around, that is going to continue through the end of the year. Would you agree?
Yes, for sure.
Okay. And then I would say in the first quarter, I think that rates are going to actually drop down. We're going to see a whole bunch of refinances happening. Dan, you seem to think it might be even heading downward after the first quarter. Do you think?
It's hard to say. Obviously, we don't have a crystal ball, but some of the people that I watch, economists, that kind of thing, think the rates will come down next year. Not sure when, but within the next 4 to 9 months, you could see lower rates than where they are now. They're pretty high right now.
Right.
But the rate you lock in today, you're probably going to want to refinance it in the future.
Right.
And that's going to be a short time frame. We're talking within a year, I would say.
Okay, so that just gives you some really good planning metrics. And if you want to delve into that more, you can ask the question. You can reach out to Dan. We'll have Dan's contact information down below in the link. And with that, we can give you what our best. Well, really, people are just making guesstimates at the end of the day. They're making their predictions. Fortunately, we've been pretty good about our predictions. Yep. Hey, one example, we said that in September that it would be the next time that the Feds would raise rates again at 0.75. They did that yesterday.
They did.
Okay, snaps for us. Remember, this is super cool to remember because the Feds have nothing to do with long-term mortgage rates, right?
That's right.
Okay, so that's your home equity line of credit, or what some people call a HELOC, your car loans, your business loans, what banks lend to each other. That is the rate that the Fed set. Long-term mortgage rates, those are based on what are publicly traded stocks, your mortgage-backed securities, 10-year treasuries, which is one of the most common ones that people follow, and your bond rates. Those are things that you want to kind of pay attention to, and that's going to give you trend. So as things kind of settle out, as we start to kind of get a hold on inflation, we're going to start to see probably interest rates for long-term mortgages start to come back down again.
Right.
Would you agree with that?
Yes.
All right, fair enough. Now, sermon's over. Let's talk a little bit about this. Dan's forte. Dan wanted to come in and he's like, hey, dude, you've got to talk to these people about different options out there. There's some pretty cool things out there that will help the buyers and all of the price points, including jumbos, except for one. And it allows us to be able to really get you really great information. That's why Dan's here.
Right.
The first one, seller paid temporary buy down.
Yep.
What is that? Tell us a little bit about what is it?
You're probably, this is kind of a popular thing right now that's happening, and I want to make sure people understand what it is. It's essentially prepaying interest for 2 years in a lump sum, which allows you to have a payment associated with a lower rate for the first 2 years. So to give an example, let's just say the rate is 6 1/4. If the rate today is 6 1/4 on what's called a 2-1 buy down, you're going to get for the first year 2% lower, so 4 1/4 that first year.
Okay.
The second year, a year goes by, it will for sure go up to 5 1/4. And then a year later to 6 1/4, and that'll be your rate forever.
Okay.
At the end of the term.
So in essence, what you're doing is you're kind of buying some flexibility, especially if the seller's willing to do it.
Right.
It's buying you that flexibility for the first year,
right,
so that you can kind of acclimate to it, knowing that the next year we're gonna pop up in rate.
Right.
Okay.
And the real value to this, in my opinion, is if you can get this, having the seller pay for this, you're probably going, because of what we just said before, you're probably going to refinance.
More than likely.
More than likely. So
right.
Let's just, for the example, you buy a house today, you get a really good deal because all the buyers are sitting on the sidelines waiting for the rates to go down. And so you can negotiate a good deal. You can negotiate the seller to pay the buy down cost.
2.5 points.
It's about 2.25 points.
2.25.
So $500,000 loan, it's about $11,000. You have the seller pay that, negotiate that in. In 6 months or 9 months, let's say the rates drop to 4.5%, 5%. Well, you're going to want to refinance and get out of this eventual 6.25 rate.
Sure.
You're going to want to drop that to that 5% rate. So that 11,000, some of it's been eaten up because of the 9 months that you've had benefit of it.
Right.
But there's going to be some money left over. That goes to your principal. So you don't lose that money. You're not like jeopardizing that money you paid or that the seller paid up front. Essentially, you paid through negotiation.
Right.
You're not jeopardizing that money. It's coming back to you. So if you think, or if you hear that you think that rates are going to go down, which I think they are, and you'll probably refinance eventual 6.25 rate down to 5 or whatever, maybe even lower, you should do this, have the seller pay it, and you'll receive the money that you don't use.
So just to keep it super simple for
Yeah.
folks that are going,
Yeah.
oh my gosh, man, you just went over a lot.
Yeah.
Okay. So if we talk about the seller, and let's just use $11,000, we're going to use your $500,000 example. Okay. Because this is not for jumbos. Is that correct?
Right.
Okay. So that's $715,000 or less.
15, and then high balance, King, Snohomish, Pierce.
Okay.
Gonna they haven't come out with it yet, but it's gonna be about 950.
Okay. That'll be cool.
Almost a jumbo loan.
That's almost a jumbo loan.
Yeah.
All right. So you have this bucket. And the seller, in his example, 500,000, 2.25 points, is going to put $11,000 in this bucket. And each month, it's prepaying that interest. But let's say in 9 months, Dan says, with his crystal ball polish, the rates are going to go down. You say, dude, I'm going to refinance.
Right.
Okay. So with that, I'm going to go from my payment here. I'm going to lock in, let's say, at 4.5%. If I have $7,000, $6,000 of interest still in my bucket,
Right.
they're going to pull that out. They're going to apply it to principal.
That's right.
So that I get a principal reduction.
Right.
And then I get my new rate, which will be for the entire term of the mortgage.
Right.
Is that about right?
Yes.
There you go.
So that's a temporary buy down. You're temporarily buying down the rate for 2 years. 2% the first year, 1% the second year, and then it goes to the note rate, the going rate. And there's also another one that if you want more information on, there's a 3-2-1 buy down, and it goes down 3% below the going rate. So in that scenario, you'd be at 3.25 in your first year.
Okay.
So,
but again, because you're prepaying interest, it's not free. You have to either prepay it or have the seller pay it, but somebody's going to prepay the interest on it.
That's right. Yeah.
Is it the same rules that if they cash out early that they get a principal reduction?
Yes.
There you go.
Yeah.
So really, at the end of the day, it's a kind of a risk, but it's a very strategic risk if you believe that rates are going to go down, but yet you need a lower rate today just for budgeting or emotional sense, right?
Yep.
So there's a really great option for you guys to consider.
Yep.
Let's go on to number 2. We have the lock-in shop.
Yes.
What is lock-in shop?
Lock-in shop is just what it sounds like. You're locking in a rate, today's rate, while you shop for your mortgage.
Which is, okay, but this is super important
You shop
because,
for a home.
because historically and normally, I could not lock my rate until after I had mutual acceptance, a signed purchase and sale agreement between myself and the seller.
That's right.
Okay, this is different because now for those folks that are seeing or have concerns about interest rates going up, something cataclysmic happens or whatnot, there goes mortgage interest rates. What you're saying is, hey, I'm going to allow you to lock that rate. Even if it goes up 2%, you get to lock that rate.
Yeah, I mean, if you would have done this 30 days ago,
Yeah.
you would be in the 5s, 5.75, 5.5, something like that.
Right.
Now you're at 6, 6.25, 6.5, even depending on the scenario. So if you would have done that lock-in shop 30 days ago, you'd be really happy.
Different question.
That could be the same going forward.
Absolutely, because we're saying that between now and the end of the year, you and I both agree rates are going up.
Right.
So just understand that.
And one big point that I've heard people, I hear a lot of people that they're on the sidelines waiting for rates to drop before they buy. And that's everybody I'm talking to. It's like a broken record. And so what I want to explain to people is this is an opportunity.
Right.
Because if you go out there and the seller is, wants to sell and is motivated to sell, they are likely to agree to some of these things. Do you agree with that?
Absolutely agree. In fact, we are working with a few sellers right now that are doing this very thing because it allows that buyer to come in and gives them that security. And when interest rates do come down, because based on our prediction, we'll be able to see, they're going to be able to see basically a realized lower payment, which allows them to acclimate to higher payments as income grows and whatnot.
And if you're looking to sell your house, you could promote this idea. Is that
as an incentive? Yep.
Yeah. You can promote that in your sale. Say, I will do a buy down, a temporary buy down, for your any buyers that come in.
Right.
And implement that. So that's another
option.
Option.
Yeah. There's great ideas for that one, and it just depends, case by case. Go ahead.
Back to the lock-in shop. Sorry, we kind of went off a little tangent there. But lock-in, today's rate, you have 60 days to find a house. If you find a house on day 59, we'll extend your rate 30 days.
Okay.
We'll extend it 30 days once you're in contract if you need it. So up to 90 days essentially of a lock.
But they have to be under contract in the 60 days.
Yes.
Okay, or it just resets itself.
Oh yeah, just relock it, but you're going to be at that the market rate.
Okay, I'm going to ask you, this is super loaded. Probably going to hit me. Step back for this one. All right, here we go. What if I lock a rate today at 6% and rates go down to 5 3/4?
I would meet you halfway.
Right on, that's what I want to hear.
It'd be a 5.875.
Okay,
Yeah,
because
there's options to do renegotiation on the rate.
Okay, because that's going to be a question that's going to be asked. I hear this one coming. So there you guys have it.
It's a good question.
It's solid. All right, here we go. Number 3. A little bit different, a little less desirable, but still an option, because if you can get a seller who's maybe motivated and catch them just before a price reduction, use that as a permanent buy down, which is what this one is, right? Yeah,
so we talked about the temporary buy down. This is a long-term or permanent buy down. So that's instead of this, let's use the 2.2 points that you could use to do the temporary buy down. That you can put that money instead towards a long-term buy down. So let's say rates are 6 1/4, maybe that 2 1/4, 2.2 points will buy your rate down to 5.75.
Right.
I don't know if that's the exact number, so don't quote me on that. But that's the concept. Then you're going to have 5.75 from day one all the way through.
So the rest of your career.
Right. So you just lock in at 5.75, but there is a cost to that. Instead of using it towards number 1, you're using it towards number 3. And the only reason I would recommend that to anybody is if you don't think rates are coming down.
I was just going to say, for those people that are going to be, ultra conservative, say, hey, listen, you know what? I can't risk it.
Yeah.
I'm on a very fixed budget. I need to make sure that I know exactly what I'm going to be. And I know it would be super nice, but this is what I need. And I need that because I'm conservative. I need to make sure.
Yeah.
That would be a good fit for them.
And to make sure it's clear, if you were to refinance this in a year, same thing. If it went down to 4.5,
right,
you probably will refinance, even if you paid those points.
Right.
There's no refund. There's no money going towards principal.
There's no bucket that comes
bucket
out of.
It was spent in the beginning.
Right.
So that's the reason I would probably hedge towards number 1. If you think in your budget you can handle the 3rd year rate.
Right.
Because you can refi anytime. So within that 3 to 5 year window, maybe you'll have to pay that higher rate for 3 to couple years.
Right.
But if you can handle that, it might be worth it in the long run. If you think you're going to be in your house for a long time. And the other thing is we do qualify people at the higher rate on number 1.
Okay.
So they have to qualify for that rate anyway, the highest rate. The highest
right,
payment.
which would make sense.
Yeah.
It just makes it easier kind of acclimating to that payment.
So it's a strategy to have this. Number 1 is a strategy to I keep gravitating towards that. It's a strategy to have a low payment for the first couple of years if you think rates are going low. If you don't think they're going low, then we can look at number 3.
And people would say, why would I do this? And the first response is, 1, it allows you kind of an ease into a specific payment.
Yep.
2, there's the higher probability that you're going to have a greater earning ability in the future, which allows you time, again, to allow salary or whatever you're doing to come up with that. So it buys you additional time. And that's really, I think, where the key benefit is.
Yeah.
Dan and I both agree that we think that disclaimer, from our projections and the metrics that we're looking at every single day, we're seeing Q1 as rates coming down. However, for the rest of the year, heading in a upward trend. So just my humble opinion.
Yep.
He concurs, and we're we should put those hats on. Remember?
No.
Yeah. All right. If you guys have any questions, reach out. Dan's information is going to be below. Have an absolutely beautiful day. We will see you on the next video. Dan,
Thank you.
as always, my friend,
All right.
you take care.
Have a good day.